Hello, world, or the few of you who are watching this live. I know that more people will come. I'm going to do a quick little shout out to Zapstream because we're live. By the way, the last time I did a Zapstream with Mike Alfred, the Zapstream just suddenly stopped working, and I realized that my sats ran out on Zapstream. You got to pay to live stream there. And so I restocked the sats there. So hopefully it won't be running out again. Apologies to anybody who was watching on Zapstream last time and missed the show. So here we are. You know what? So Joe Carlasare is a good friend of mine, and he is going to jump on at some point. He's a busy guy, as you guys know. He's an attorney, and his work schedule can be a little busy, but he said he'll try to make it. So at some point he'll join in, but in the meantime, I'm just going to get started. And I have a little presentation, which I tell you, I can't even believe I'm about to say what I'm going to say. Some people might see the title and think that it's Joe who is bearish, but I'm actually getting increasingly bearish, and I'll go through why here. So apologies for anybody. I generally like to be optimistic. I've been bullish for quite a while, and so it feels weird to watch the incoming data and to have to pivot. As a fund manager, I have to be willing to change when the facts change. And I think the facts are changing, and I think it has a lot to do with the new administration, for better or for worse. I don't, I don't really care. I don't have an opinion on whether it's good or bad. My job is to, preserve and protect my clients' money in the hedge fund. So that's what I'm going to try to do, and hopefully it'll be interesting for you guys. And I'm sure Joe will have some good takes too. So real quick, just want to acknowledge people in the chat. Kevin, good morning. Caleb, hey. Matthew, you're welcome. David, first time watcher, let's go. And Luis, hello from Madrid, Luis. That's great. Or Luis, glad to see you. Glad you're here. I get psyched when people are telling me where they're from around the world. I'm in Colorado, so it's fun to see where other people are from. So let me go ahead and get started with the presentation, because I think there is a lot to talk about today, as you can imagine. Let me go here. Hey, thanks for Guy that sits over on Zapstream, 1,000 sats. Thank you, brother. That's awesome. I appreciate you. Thank you. It goes towards funding, this show, which isn't free to run. I tell people if I get enough sats, maybe someday I'll buy a real microphone and be like the real live streamers. But for now, we're gonna make do with that with the headphones. So, this is my usual beginning slide. It's not another podcast. I don't want to do like a traditional Bitcoin podcast. I already think there's too many of them. I know a lot of people think you can never have too many. I don't agree with that. This is just me. As a fund manager, I spend a lot of time thinking about macro, looking at charts, making decisions within my portfolio. And I also, I'm a Christian and I like to help people. And honestly, that's the only reason I'm doing this. I'm not looking for clients. I'm not looking for patients. I'm not practicing as a doctor anymore. I'm just here to share, with my thoughts out loud. I'm just here to share with you what I'm thinking about. And I'll be wrong a lot. Sometimes I'm right, but I'm often wrong. Let's see. Joe's saying he didn't send it to me. Hang on just a second here. Yes. Different. Sorry guys, I'm actually texting with our guest for today. Let's see here. Sorry, this is I'm actually texting with Joe Carlasare right now, so I'm trying to get him on here. Okay, let me try doing this. Invite. This makes for really good live TV, right? This is the ultimate in live streaming right now. Okay, I'm gonna see if that works. All right, hopefully that works. Okay, where were we? So hopefully come on real quick. Hey, David from Sweden, Gianni from South Africa, huge fan. Thanks, Gianni. Johan from Amsterdam. Also, oh my gosh, you guys are from everywhere. This is pretty fantastic. Cape Town, Doug. Eddie, hey Doc. What's up, Eddie? Goobtron, I will try to not stop doing these videos, although, they're not very fun to do in bear markets, but here we are. Philip from Castle Rock, let's go. You're close. How about that wind we've been having for the last, 12 hours, huh? It's been something. Okay. All right. So hopefully this is going to work to get Joe on. And let me just keep going. So why am I doing this? You guys know, right? I like to talk about all this stuff. I like to talk about macro. I like to talk about Bitcoin. I like to talk about investing. I used to be a value investor before I discovered Bitcoin. And then and then I transitioned also, like right around the time while I was figuring out Bitcoin. I also figured out growth stocks, and I came to the conclusion, 5 to 8 years ago, that value investing doesn't work very well in a centrally controlled economy. When the central banks are in control, as they have been since the global financial crisis in 2008, 2009, you have to change, you have to adapt or you die, right? So adapt or die. There's a reason people say that. And so that's what I've had to do. And I think Joe is here now. Hey, Joe, can you hear me?
Yeah, can you hear me?
Yeah, I sure can. All right, guys,
Awesome.
Joe made it. Sorry about sending it to the wrong place.
No worries, no worries.
Hey, cool. So before I get your thoughts, Joe, let me go through my little presentation, and then let's just talk about it as we go. Does that sound good?
Perfect.
Okay, cool.
How can I tweet this out though? Is there a link somewhere or?
How can you tweet this out? Let me see here. If I do, I don't know.
Okay, well,
Actually,
just go
here,
ahead.
no, I can
Don't let
do.
me interrupt. Go ahead.
Here, let me do this. This is the beauty of live stream. Let me share a link for the audience, and I'm going to put it. Can you see the chat on the right hand side? If you click on chat of Riverside.
Yes, I see it now.
Do you see that? You see what I just posted there?
Yes.
That should be a link to the show here.
Awesome. Thank you.
Otherwise, we are live streaming right now on YouTube and on Zapstream. So you could go to YouTube, click on that, and share the link if that's better.
I got it. Go ahead. Let's
Nice.
get into this.
Okay, so what I usually do, Joe, and this is funny, is I usually have my reasons to be optimistic, but you'll notice with my clever PowerPointing that I'm actually, I can't even believe and right before you came on, Joe, I was just saying, I can't believe I'm actually saying what I'm saying, but I'm turning bearish. And it's all changed like just like that. And I was laying in, I couldn't sleep last night. I woke up at 3:15 this morning, and I've been awake since 3:15. And I was thinking about this, and I thought, what has happened is, it's like being prepared for summer to come. Like you're putting away your winter clothes, your scarves, your mittens, your boots. You're pulling out your Speedos and your bikinis and your tank tops and your shorts, and all of a sudden the Earth, it was tilting this way, tilting. Here's the sun, here's the Earth tilting. So summer is going to hit the northern hemisphere, and then it's like it just stopped, and then starts tilting back in the other direction. And so now suddenly winter is coming back again. So to me, this is almost as profound as what I think is happening right now, and we'll get into reasons why. So what I'm saying, point number one, I think macro summer has been canceled for now. What I say when I mean by macro summer is, I have been expecting growth and inflation to not be crazy, but to surprise a little bit to the upside. That's what I've been planning for all the way through until the last couple of days. And now I think all of that is flipping on its head. And now when I peer into the future, looking at data in cycles, I think that we are legitimately going to see growth and inflation surprise to the downside. And I think that's being reflected in the bond markets. I think it's being reflected in risk assets. It's being reflected in Bitcoin. So hang on, I'm going to keep going. So reversal of the Earth's tilt, I just talked about that. Are we heading back into macro winter? This is just what I just said. I was previously expecting U.S. economic growth and inflation to surprise mildly to the upside in the first half of 2025. But the Trump administration policy changes are already having a huge impact. All right. So tariffs and tariff threats led to a massive surge in first quarter 2025 imports, which is causing a massive, and this is what I just sort of blew this off. Like it's probably just temporary, not a big deal. Decline in GDP growth. So GDP now is now predicting a negative 2.8% GDP growth for the first quarter. Here's the chart, Joe. I'm sure you've been talking about this.
Well, why do you think it's printing that?
Well, we know why it's printing that. It's because of imports, right? So
Exactly.
Yeah. So hang on, because I really want to talk to you about this and about whether you think this is temporary or real. So let's come back to this. Hang on. Long-term Treasury yields are strongly suggesting material or lower in future growth and inflation expectations. TLT looks bullish to me for the first time in a very long time, and I don't mean long-term bullish. I mean short-term, like quarters. I think I think 2021 or so, 2020 started was the end of the 40-year or so bull market in bonds, and I think we're at the beginning phases of like a 40-year or so bear market in bonds. That's my take, and we can talk about that. Should I stop there or should we? We got a lot of stuff to talk about.
Keep going.
Okay. I'll keep going through the presentation. February ISM, you guys know who watch this channel. I watch this closely. ISM Manufacturing PMI came out yesterday, 50.3 versus last month was 50.9. That was disappointing, but still barely expansionary. So that's, okay. Manufacturing new orders, which I really watch closely because this is a forward-looking indicator, dropped from 55.1 last month to 48.6. That usually front runs what the ISM Manufacturing PMI does. Why do I care about that? Because the two things I follow most closely as a fund manager, especially pertaining to Bitcoin, is that Bitcoin does the best when global M2 monetary supply is expanding and when US manufacturing PMI is expanding. So above 50 and accelerating. That's literally like my main thing, those two things that I look for to trigger the next bull market. I was very excited last month because it looked like, okay, here we go. Yep. Like, right. We had last month 50.9 new orders were ripping. I'm like, this is it. Here we go. And then everything just ground to a halt here. Okay. We're getting there, guys. Joe's thoughts coming up. Joe has the actual answers. I always just, throw my guesses out here. So risk assets and especially Bitcoin, this is just what I just said, right? I'm front running myself. You can read it for yourself. In light of decelerating economic growth, inflation, and interest rates, I am tilting bearish for the first time since early 2022. And by the way, guys, I hate to say this, right? Because I've been very, very bullish about 2025. And I've been making fun of the recessionistas. I'm going to have to eat some serious crow, probably. I don't know that we're heading into an actual recession, but we may get close to it enough to force the Fed's hand. All right, I can't wait. Joe's reacting. This is perfect. We're going to have a good conversation. Okay. I am as surprised as you. See, I keep front running myself. Here's my take-home points, and then we get to Joe. Number one, decelerating economic growth and inflation are generally bearish for risk assets and Bitcoin. Number two, Treasury bond market is confirming this bearish outlook for now or for the foreseeable future, right? Three, as a long-term trader, I almost always follow my trailing stop losses because I've learned to listen to the market rather than my own drivel. So I have my macro points. I go on shows a lot and talk about my macro. I only trust it as far as the markets agree with me. So when the markets, when the assets I own start to disagree with me, like for instance, last week I was still shorting bonds. I closed out my trade, it got stopped out, and I actually opened a new long Treasury position today. And we'll see how that goes. Number four, Bitcoiners should disregard all of this. Seriously, just stay humble and stack sats, like Odell says, and be thankful for the cheaper sats while we have them. I mean that, by the way. Take home point number five, the Trump administration policy changes downsize and deregulate with deafening speed, the 3Ds, and reprivatization. I think that's the word that Scott Bessent uses, which I like actually. They may be fundamentally altering the 4-year cycles that we've grown accustomed to since 2008, 2009. So again, I want to get Joe's opinion on this. For now, all of my bets are off, meaning everything I said, like I'm literally questioning everything right now. So when I question everything, I go to my counsel, Joe Carlasare, Quote of the day: "May you live in interesting times." Old Chinese proverb. This was popularized by Robert F. Kennedy in his 1966 Ripple of Hope speech. It's some people think it's a curse. Some people think it's a blessing. Remains to be seen. Okay, that's my whole presentation. I'm whipping through it so that I can get to the conversation with Joe. Joe, tell me your thoughts.
Okay, so I think you start from the growth picture. And I know that there's a freak out over the Atlanta Fed GDP now, but it's one of those situations where we know exactly what is causing the decline. You don't have to take their word for it. You can look at it's really open source. You can look at what's driving the model down. And just to be clear, Atlanta Fed GDP now bounces around quite a bit, right? There were periods last year where it was projecting close to 3% growth, right? We didn't actually print that in real terms, right? It came down south of that. So it bounces around a lot, right? Now, the recent move has been by this, I think it's like, what is it, $150 billion in trade deficit? That is most likely, I think, firms doing what's quite predictable, which is front running the tariffs, right? So I'm curious why is the Atlanta Fed GDP now the primary reason you believe, Jeff, that the growth is softening, or is it ISM,
It's the
or is it
ISM.
both?
So
Okay.
so it was the ISM that I was waiting for yesterday, and when that came out, it was sort of like a slap in the face, which then brought me back to because Joe, I got to tell you, Lynn Alden posted that same GDP Now thing, and somebody responded. Trey Sellers responded with, "I think it's just the imports," and I responded to that saying, "Yes, I do too. I think this is just a
Yeah.
temporary blip. Doesn't bother me." But then the ISM came out, and I'm like, "Oh shoot!" Like it actually is having a real effect though on the economy. That's
But
what bothers me.
ISBM's been weak for what, 9? I mean, actually, the manufacturing PMI as of January hit like a 9-month high, right?
Yes,
So that data is noisy too. So I
it is.
guess is there anything else in terms of fundamental macro data you're looking at? Because the reason I start there is that you and I both know, and I think we agree on this, that um, the fundamental macro data isn't really what's important. What really is important is the liquidity picture. The liquidity picture, and obviously I tweeted out yesterday, I'm like, okay, if the S&P declines 25, 30%, right, you're going into a recession. This is where I take an issue with the fundamental macro. It's not that the S&P leads the economy. I think the S&P markets declining actually triggers the recession. I think it pulls it down, and I think you can't wipe out trillions of dollars of collateral in the system without causing a recession. So that's where, like, I'm looking at this saying, okay, it's almost a self-fulfilling prophecy. The market going down, which is what apparently Bessent and Trump seems to want, which is a fascinating thing we could talk about. I know that real smart people, much more so than I, are saying, well, that's the goal. The goal is crush inflation by collapsing asset prices and be able to blame it on the prior administration, which they're openly saying. Okay. But the thing for me that's most important is what is the actual economy doing? Because collapsing asset prices in the short run, while that may trigger a recession, it is always one of those things where is this really just a goal to get yields down so you can get Fed cuts so that you can restart it? And this is really just a blip we'll be talking about 6 months from now with asset prices heading higher because inflation has finally gotten brought down. Somebody tweeted out today, and I'll just quote. I'll get the exact tweet, but I agree with it. I bet Powell's seeing some of this, seeing asset prices come down, seeing the 10-year go down. I bet he's pretty happy about it. I mean, don't you think? I mean, that's kind of
Yeah,
what he wants. It's not that he's, his arms being twisted to cause cuts. He wants that 10-year to come down. He said openly to Congress he doesn't control it, right? It's market driven. It bounces around a lot. So I guess what I'm saying here is this really one of these things where we're talking ourselves into a down market, or is it something fundamental that's really weakening? Because the ISM, we're a service-based economy. ISM matters, right? But how much so in
yes,
a service-based economy?
yes. So I say all that exact same stuff as we do these these mastermind discussions and other things like that. And I agree. I think the U.S. is primarily a services-based economy, but for whatever reason, so looking at Bitcoin in particular, Bitcoin does really well once the PMI, like I said earlier, spikes above 50 and then moves higher in
Right.
conjunction with an expanding global M2 monetary supply. So you had asked early, and that's why I pay attention to that as far as my fund goes. But normally I'm more concerned with what the services economy is doing. Why do I think it's more real than just that? right, bond yields, as you just talked about, bond yields, the long-term yields are a reflection of future growth and inflation expectations, right? That's how I view it.
Yeah, no,
I,
I agree, but they bounce around a lot. So
right, but the yield curve is inverted again.
yeah.
So it's distorted again. I agree that. So I was saying even up to a week ago that the Fed doesn't matter anymore. But now I think the Fed is going to start to matter again. I think the bond market is going to force the Fed to start lowering rates. And you probably agree with that. Let me see. Is this on
Well, but
here?
just for context for the listeners, right? We're sitting at a 10-year just above 4.13, right? Which is, by the way, where it was in December. Okay.
Yep.
And by the way, it was where it was in October. And before that, it was where it was in March of 24. So like, it's hovering within this range, chopping around. I don't know if you can pull it up on the chart.
Yes.
Oh, you have. Okay. Yeah. I mean, it's hovering within this range. By the way, the current 10-year, just for those following, it is almost darn near within like 7 or 8 basis points of where it was when the bond market bottomed out in 2022, in
Yep.
October of 2022. So you have to look at this thing in context, right? Like, yes, it has come down. It's come off the highs of the yield, which I was expecting, and I traded that. But I'm wondering, like, is that it's not like it's crashing to 3.5% or 3%, right? That says imminent recession here, get the hell out. So that's, I don't know. What do you take on that? Any of that?
But so I agree with you. And again, I would have totally said that previously. And in fact, that's why I have been short bonds up until last week, because I thought, if anything, we're going to see, this is probably just a local bottom. We're going to see growth and inflation accelerate a little bit from here. Everybody's, they're, panicking a little bit more than they need to. The indicators that I follow, though, suggest that this is a little more real, that this is going to be more of a substantial move. And again, I'm not calling for
In
like
what? In GDP? Are you or their stocks?
so all of it. So I think they're all saying the same thing to me right now. I think so yields falling, so the long end falling, global PMI disappointing, new orders especially back into contraction mode. GDP, which I wrote off as a one-off, I think, well, maybe, when you have a certain view, if anything tends to disagree with your view, at least for me, I tend to blow it off as like,
Yeah,
that's
that's
just this, right?
human
Human nature.
nature. Yeah.
So that's what I have been doing. But now as I keep looking at this other data, also, so in my fund, right, I have all the Meg 7 stocks, Bitcoin, lots of other things, kind of spanning. I have like 30 different stocks that I follow really closely. All of the tech stocks look very toppy to me. Some of them are already rolling over and are just flat out bearish from a longer term perspective. Let me throw up a good example here. So Microsoft, right? I mean, clearly is rolling over and turning down. Could it pop back up? Sure. But I think that when I look at all of the Meg 7 stocks, I see, obviously their multiples are hugely expanded right now. But when you don't have the economy backing it and monetary supply backing it strongly, you don't see the multiple expansion. You start to get multiple contraction.
But that's where can we pull that apart for a second? So
Yeah.
the monetary piece of it, okay? The tariffs have already resulted in a pricing in at least of one more cut, okay? And maybe that doesn't matter. Maybe that's irrelevant, right? Because it is kind of, 125 bip cut. Who really cares? Is that amount a whole lot? But you've also got the 10-year coming down, which I think we agree on is far more impactful for consumers. That's going to drive a real estate, at least some credit impulse in the real estate market with mortgage rates under 7%, right, across the board here. So I guess what I'm curious about is that if the tariffs I also saw OPEC. OPEC's increasing supply. They're going to do a supply hike. So that's also disinflationary. And if you go back like 3 months, the thing everybody was talking about is second wave of inflation. There's a second wave of inflation. That's the most important thing. The market cares about that. You're seeing serious disinflationary forces take hold. So my question to you is, if that is true and inflation's coming down, why isn't that positive? Unless the only argument I could see, if playing devil's advocate with myself, is like, okay, it's not positive for risk assets because inflation's coming down for the wrong reason. It's coming down because you're entering growth weakness. Is that your view? Is that
Yes, exactly. So the only time disinflation is bad is when you have concurrent growth weakness. So when you have, and again, these both took me by surprise. When I was looking ahead, both of these were supposed to be accelerating a little bit right now, and both are now decelerating. For the month of February, it looks like for the month of March, we're going to see more disinflation and more decelerating GDP growth as well. And it looks like now that's going to continue into the second quarter. That's basically the only setup that I see that's actually bad for tech stocks and actually bad for Bitcoin.
Can you explain that? Why do you think it's going? And that's where I agree with you. The Atlanta Fed now, I agree with you. Well, I think the Atlanta Fed now is noisy, but putting aside, I agree with you with
Sure.
the PMIs. They're disappointed. But what is telling you that this is in a trough? Tell me that.
Just putting all of the things together. So watching these overvalued stocks roll over, looking at what normally does well in this type of environment where you have slowing economic growth and disinflation. What does well are things like utilities, consumer staples, and long bonds, being long bonds. And all of those things are breaking out to the upside now for the first time in quite a while. And I can show some of that stuff too
Yeah,
here.
can show me the utility picture because
Yeah.
that's interesting to me.
So can you see that utilities now? XLU.
Yes,
Okay.
yes.
So to me, this is a very healthy looking chart. It was kind of trending sideways throughout most of 23 and into 2024. When all the Mag 7s were just crushing it, tech was crushing it, it lags, and that's pretty standard. And then since here we are the bottom here, October of 2023, it's been on a tear and it's a pretty strong bull market. I think that looks like this is, if I don't own this in my fund, but if I did, I would be very long this right now and adding to this position.
Okay, so just another way of looking at this
Yep.
that I think is helpful. Pull up the ratio chart, and this is when I look. It's the SPY over the XLU.
Sure. Hey, by the way, you can share your screen too if you want to.
Oh, can I?
Yeah, that'd be great. So
Okay.
down below, I think you have the same thing as me. Do you see where it says stop?
It says somebody else is currently sharing. So
yeah, so I'm stopping. Now do you see share?
Yeah. Okay, perfect. Window. Don't want all my attorney-client privilege documents to come up here, but
Yeah.
okay. Here we go. So
nice.
This is the XLU. I don't know if I can make this bigger. Can you see this all right?
Yep, looks good.
Okay.
And by the way, there's some people who are just listening to this, so try to describe.
Oh, no, I'll describe it. So this is where I'm interested here, right? So like what I see in this chart is sort of the opposite. I'm looking at a chart here where if you take SBY, which is the market cap S&P 500 construction ETF, right? It's constructed based on market cap. You put it in a ratio against utilities. You have the November 21 high, which looks to me to be going to be tested. I think this November 2021 high, where you had, obviously that's massive peak in risk assets across the board, followed by the very brutal 2022 downturn, right? It looks to me like this area, this pocket, needs to be tested. And what you see in the chart is that 2022 we sell off really hard the SPY versus utilities, which is consistent with the risk-off atmosphere. Then you have the burst forward with the risk on. And interestingly enough, this actually peaks in February of 2024, which, by the way, is coincident roughly with the launch of the Bitcoin spot ETFs, right? You're seeing them right around this period where you see a massive wave. What do you see after that? You've basically seen that the peak SPY and utilities was made back in February of 2024. So through most of 2024, you've actually not had, from the risk-on standpoint, if you're just taking the S&P 500, you've not had the bullish market that people were expecting. In fact, since February 24, utilities have outperformed SPY by 13%, right, Jeff?
Mm-hmm. Yep.
Okay, so to me, that is telling you that this period that we've seen basically for the last 12 months has been solid, right? Like, I mean, if you look at the nominal chart of SPY, it's not like the market sold off, but it really has been more of a defensive environment. It has not been the rip roaring market. So what are the possible paths forward here? The possible fast forward of, what I see is you make a stand here, right? I don't know why I did that, but you make a stand in this area,
Yep.
and then you go higher, right?
Sure.
Or it breaks down, massive recession, the end is here,
Yes.
right? To me, okay, I don't see this. I think this is very unlikely, given the growth picture, given you still have high deficits to GDP. Yes, I understand Doge and all the narrative around that, but this does not seem likely to be. I'm curious to you, if you had to put a probability here on this scenario where full on market is peaked, the rest of the year is down, you said macro summer is over, it's not coming. What would you assign this probability here?
So
We
so
don't have a
right
crystal ball,
right,
but
I don't. So right now, okay, so what I'm waiting for, I think the next major event to happen is going to be the Fed capitulating and restarting QE at some point. Once they do that, I'll probably get bullish again. Like once I know that the Fed is behind the markets and is going to start, doing what they can to prop it up, that will probably help me to pivot bullish again. But for now, I think that it's heading lower until further notice, I guess is the way I would say that. I'd say we're going to continue to see utilities outperform. We're going to continue to see rates going lower in general until something changes and until we get that pivot.
what but from a probability standpoint, so you're saying confidence level, okay? And I understand you don't
Sure.
have a crystal ball. I don't
Yeah.
either. But
Yep.
I always try to say, like, with my views, my confidence level is X%. Like, I think
Sure.
that to give your framing, right? Until there's a significant change on the QE front, which, by the way, Paul has said, I'm not doing QE unless rates are zero, which I really find it hard to believe that rates are headed for zero. I mean, think about that. If rates are going to get to zero, you have not just a mild recession. You have a very, very painful recession. You have S&P below 4,500 type
Yeah.
recessionary forces. So, like, to me, I think in the scenario you're laying out, well, QE, monetary easing, that sort of thing, that seems so unlikely here. Maybe you're right. If I had to put a probability level on that, it would be less than 20%,
Mm.
that's where we're going. But where are you? You have a sound like 80,
Yeah.
like
Yeah. I
80%.
was gonna say I'd say about 70%.
Wow.
And until I see a pivot where the Fed is getting behind this or something changes, I have an increasingly high conviction that we're just headed lower. Uh,
People were criticizing the Fed last year. Okay, not even last year. Like what, 10, 13, what is it, 9 months ago, saying,
yeah,
"Oh, they shouldn't be cutting." Right? We're in an inflationary
right.
environment. This is only going to pour gasoline. Okay, well now those people have to eat their words. If you're correct, and we're on the verge, they did exactly what they should have done. That 50 basis cut was spot on, perfection from Powell. Right? He could have done more probably if what you're saying is true, which I think is fascinating, right? Because everybody likes to be armchair quarterbacking it and saying, "Here's what they're doing wrong." But if what you're saying is correct, like they didn't get behind the curve, they were doing it. And they probably should have done more. They probably should have stopped QT, which, by the way, they're still technically doing QT. They're still
Right.
withdrawing liquidity from the system.
Right.
So I'm curious, like, do you think that Jerome Powell and the rest of the FOMC, that they agree with you, or do you think that they're behind the curve and they're still they're underestimating the disinflationary forces in effect?
I think they are behind the curve. I think it's just sort of fortunate that it worked out for them this way,
Interesting.
because I think they were just following. They always look in the rearview mirror, right? They're
Yeah,
looking at old data. Everybody knows that,
completely
and they
agree.
just basically admit that. Um,
But
I
they were
think it
criticized for cutting. I mean, like,
right,
that was the main narrative.
but
Like, why are you doing this?
and I would say they should have been criticized because I was one of those people who thought we're cutting into an economy that's revving up, into inflation that's starting to pick up again. And now, again, I just feel like on a dime, almost everything has changed. And I think it's not just a blip. I actually think it's here to stay for a while. I mean, I'm pretty bearish now, which is astonishing. I literally just last week did this emergency, emergency LOL live stream about how these are great deals. This is a buy the dip opportunity in a bull market. All dips are for buying and all caps and all that kind of stuff. And I sincerely believe that. But then the data has changed to me materially and significantly enough to where it's making me make actual decisions in my fund.
But can we let me because I think I'm still missing some. You got
Yep.
ISM, you got Atlanta Fed GDP now. You've got the market-based indicators like the bonds and obviously equities. What else? What other the data are you looking at?
Well, those are pretty big for me. Like all of those things are basically what I look at. Those are my biggest indicators. And for me, to me, the market doesn't lie. The equities markets they look into the future to see what's coming. And I think what markets are anticipating is, okay, we've gone far enough. We don't have the support we thought we did. The economy isn't growing as strong as we thought it was. Inflation is actually pulling back sharp disinflation. These multiples that we have on all these amazing Mag 7 stocks are way too high suddenly. And so suddenly now there's no floor beneath them. And everybody is rotating into these cyclical things, into these sort of safety equities. And
Okay,
to me,
so
I just think,
can I pull that apart?
yep,
I want to
yep.
know. So we make a stand here or within the next 4 or 5% points. Okay, just to show you, I'll pull back up the chart here. Okay,
Yep.
This is where, and again, you may be completely right. I just need to understand. I want to understand your thinking. So, can you see the S&P
Yep.
chart I've got here?
Yep, we
Okay,
got it.
I just want to point out a couple things here. Okay, so we're back at basically the election day range, right?
Yep.
This looked like a breakout. It obviously failed. We're retesting.
And so, guys, just for people who are listening,
Sorry.
this is just a chart of the S&P 500 now.
Yeah, I'm just looking at the S&P 500 here, and what I'm going to ask you here is that this right here, to the market, the market sees all is ahead of the curve, all this stuff. This decline, which I'm highlighting for the listeners, there's a pretty decent decline from July of last year into the yen carry trade debacle,
Unwind.
whatever you want to call it. That was 10% decline. And then we rip, right? We rip seemingly without, I mean, I guess there was some positive fundamental macro data that came here, but it really, it was just basically a bunch of noise when you think about it. We had this midsummer slowdown, inflation's back, the Fed is cutting, and you have the bounce, right? Then you have another nice little correction here. I'm just curious, like if the market makes a stand here, and I know you've stated your belief very firmly, and I appreciate that. If the market makes a stand anywhere in this range and we bounce, does that change your view?
Oh, sure. Like I change as the data changes. So, but that's how I have this kind of longer term trading system I use with trailing stops, right? So if the momentum suddenly reverses, I'll close out any shorts, go back to long.
Tell us about that. What does that look like? Where would we have to bounce to give you conviction that, okay, this was a head fake?
Sure. So let me share my screen here. All right. So in a very simple way, and I don't like to give away like all the stuff, but
no, don't just
I don't own the S&P 500, but if I did, right? So I would still be long the S&P 500. This is the 50-week moving average. This is like basically a 5-year chart, weekly candles.
It's a Bollinger Band. What do you have on there?
Yeah, Bollinger Band is the blue line here. So, which kind of tells you the range of volatility that's expected. It constricted a little bit over the last few weeks, and now it's starting to open up and widen out. To me, that just suggests we're going to see a period of higher volatility for a little while. So the last time the S&P 500 dipped below its 50-week moving average, which is about a year moving average, right, was back here in early 2022, popped above, and then fell back. And then that's when the recession started in earnest for these equities back in April of 2022. Could this be another fake out like back here in October of 2023? Absolutely. So what I would expect for that to happen is for Powell, say, to come out and be like, you know what, we've done QT long enough. we think that things are looking risky. We're looking at unemployment spiking a little bit. We looked at what the GDP did, blah, blah, blah. We're going to just stop doing QT and do, maybe even if he just says we're going to stop QT, the roll off, I think that would have a positive effect. But I don't think he's going to do that yet unless we have a huge breakdown in the next 2 weeks before the next meeting. That would be my guess.
Which is possible, right?
It's totally possible. And the markets may be kind of front running Powell and like helping him along with his decision, because I've been watching I know you watch this too, the CME Fed Watch. Let's see, make sure you can see that. No, it's not on there. Hang on, let me share this screen here real quick. Stop, share. Window, where is it? Share. Okay, just so that people that are listening to this, what this is the CME Fed Watch. It's basically looking at futures probabilities of what is going to happen with the federal funds rate. Right now, the target rate is 4.25% to 4.5%. There's still an 87% chance that it's going to remain the same 2 weeks from tomorrow at the FOMC meeting and presentation afterwards. So, but what I'm watching is here. You can see this, Joe?
Yes.
Yeah, so down below, look, 1 week ago, the odds of having a single rate cut were as low as 4%, and they might have even been a little bit lower than that prior to this. But
Yeah.
I've been watching this tick up day after day, and now today it's at 13%. So still very, very low chance that they actually lower the Fed funds rate at this next meeting. But if we have enough of a dump, and if treasuries continue the yields start to, continue to decline, it may force the Fed's hand. I mean, look at the 2-year rate.
Yeah.
And I'm not, let me see, I got to share that screen now, just so people can see this in the audience here. I know you watch this, Joe.
3.9%.
Yeah, so the 2-year rate here, let me get the Bollinger
which again is higher than it was last September.
And it's exactly where it was back in September of 2022. To your point, it's basically just waffling up and down. Right?
It's at the level when people thought there was contagion in the banking system and SVB was blowing out. I mean that's the level you're at on the 2-year. That to
wild?
me, that's not screaming crisis. I don't know. The interesting thing for me is we've talked about this before. I don't focus so much on the overnight rate. I'm more concerned about what they're going to do with the balance sheet. I think that's far more meaningful. Mm-hmm. And the interesting thing is that you've got, who is it? Let me make sure I pull the right article. Look at the reverse repo, right? You talk about that all the time. Waller, who says the reverse repo, and I'm quoting him, is the excess liquidity gauge that is most important for the Fed to monitor. The excess liquidity gauge the Fed is the most important for the Fed to monitor. It's down to 78 billion. Okay,
pretty much empty.
Pretty much, yeah, right. Pretty much empty. So to me, like if you're looking at some measure of liquidity, focus on the reverse repo is far more important than the overnight rate. Like I get it. Like but that's new lending, right? That's new lending activity you're effectively influencing rather than actual securities and collateral in the system. And I think Michael Howell talks about this too. Like that seems like the more meaningful thing that the market's going to be focused on. So I don't know. Maybe the overnight rate isn't. Is there undue influence in your mind on the overnight rate? Like I know that they're not projecting a cut, but they can give guidance on the balance sheet, which to me that could cause a bullish move.
I think the guidance is everything at this next meeting. So if I had to guess, I would say that the markets are going to remain tumultuous until the meeting, and they're going to be, for the first time in a while, hanging with bated breath on the words of Powell and what the statement says. And it will be a market moving day, I think. And so basically, if they kind of just say, nah, business as usual, we're going to continue with the runoff, the QT, and we're going to keep rates as is, and we'll monitor the situation, I think markets tank at that point. That would be my guess. And it may even force his hand to do something in between meetings, have an emergency meeting, as they say. If however he hints at dovishness, if he's like, what, Mark, we want to help out, the bond markets or whatever he says, whatever, and what he says and doesn't say. But if he's basically like, let's stop QT, let's stop the roll off and just see what happens, that will be taken as bullish, I think, and I think the markets will react positively to that.
Can you pull up oil for a second here?
Yep.
And I want to know your take on this oil market, because This is one of the things I look at, and well, let me just before I prime you here, tell me what you think. What are your thoughts on the oil chart here?
Yeah, so I think it looks weak. I personally think that oil is going to be at best kind of choppy sideways throughout lots of Trump's presidency to down. I think his drill baby drill is for real, and I think that we get a huge surplus of oil. And then if you mix it in the near term with if we do have a U.S. kind of led mini recession or whatever you want to call it, a slowdown, or a mini contraction, I think that's negative for oil prices in the near term. What about you?
I agree. I mean, OPEC's saying they're going to hike supply. Okay, and you've seen oil. I mean, I've seen this pattern time and again. Right, this looks like Uh, it reminds me of it kind of reminds me of the Bitcoin chart in 2018 where it tested
Hmm.
this level again and again, 65, 67, again and again. In Bitcoin, it was like in 2018, it was like the 6K level, I remember.
Yes.
And then it breaks, right? And it
Yes.
breaks down. To me, this looks like I really want to go to, at a minimum, the high 50s. That's what it looks like to me. Now, the reason I bring that up is if that occurs and gasoline falls precipitously as a response to the oil move, that is stimulus. Okay, that it's a gross slowdown, right? But that's a lot more money in regular people's pockets,
Yes.
which makes up. And it also brings down prices across the board. So I guess I guess we're back in the phase where the pre-COVID era phase where disinflation equals bad. Whereas before, if you would have asked me 6 months ago, I think most market participants would say disinflation equals good, right? That's
Yes.
that's bullish for risk assets. That's what risk assets want to see. They want to see that CPI number print closer to 2% rather than sticking around 2.5, 2.7. I don't know. Do you disagree with that? Is that the wrong framing now? Have we entered the new era where disinflation equals bad again?
I do. And I think by the way, you keep sort of alluding to this, and I agree with you. This is generally good. These kind of things that are happening, it's sort of collapsing the K-shaped recovery that we've been having. It
Yes.
is good for the American public. If stocks come down, if mortgage rates come down, so that housing prices come down and the housing market is freed up again. If gas prices come down, that's great for the American consumer. It's great for the lower and middle income classes. I'm very excited for that from that perspective. I think they're actually trying to close that K-shaped inequality for now. Or I don't know if I should say they're trying to. I think that's what's going to happen though. And so even if we do have short-term pain in these risk assets, say Nvidia crashes 60% or something, or which is possible
Hmm.
considering its valuation, that's generally good for everybody. A price reset at lower levels would be fantastic. So I'm cheering for that. I'm with you, and I think that oil looks like it wants to drop as well, and I hope it does.
Let me can I share my screen for a
Yeah.
second? I got to show you something. I think this is funny. Um, and I want to get you on the record here in a recorded space with this one. Um, I think I can't share yet.
Oh, sorry, I got to stop mine, I think.
Okay.
There you go.
Look at this chart here. This is fun. This is not, for the people that say, CPI is all fake,
Hmm.
government number. This is the truthflation data. Okay. This is the truthflation inflation index for the United States. Um, Obviously you have this May 2020 number where we were negative, right? We actually had deflation technically in their price index. Then you have this massive burst up to what they claim was closer to 12%, much higher than the government stats. And then if you look at this number, we're now down to 1.4%, 1.4% below, what if this number is more reliable than the CPI, below the Fed's target. And the reason I want to bring this up is so was Jay Powell right all along? Was inflation transitory, Jeff?
Well, the spike in inflation was transitory. To me, I still think that's what he was saying, but it gets taken out of context all the time, so he looks stupid. I think he thought there would be this peak and it would roll over,
It
and I think
did.
and it did, and I think he was right. So yes, he was right, but the point that I think everybody else likes to bring up is it doesn't mean prices have come down. It just means the prices are going up at a
Yeah,
slower rate now.
but that's like the economist. I mean, that's how economists talk, right? Like they're
Right,
never going to say like prices are going to everything's going to get cheaper, right?
right.
The reason I'm looking, I mean, this is a massive move, right?
It
We're
is.
talking about this is just let's go to the monthly chart. So back on their own gauge, this is a private sector, private
Yeah.
outfit. They're making this. This is not the government. Okay, their inflation index as of the end of February and in the last week has fallen like 60 bips.
Yes. It's incredible.
That is huge. Like you
That
said, turning on a dime.
yes.
That's
That's what's
amazing.
so that's why I couldn't sleep last night, Joe. This is why I've been tormented. It's everything is happening so quickly. I'm like, what the heck? Like I knew it would have effects, but I didn't think it would be this dramatic and it would happen this quickly. I thought it would be sort of a slow process of rolling in, or at
Yeah,
least
and
slower.
and you may be right. I mean, I was texting you about this. Like, you may be absolutely right. Like, the thing that's troublesome for me is that sometimes these short moves, they do end up just being noise, right?
Yes.
Like it's kind of like one of those things where if it happens consistently over weeks and months, I have more confidence in it
Hmm.
as being something other than noise. Short term move like that. That's why I'll just tell you my bias, and I respect your opinion on this, but I throw out the Atlanta Fed GDP now completely with this tariff stuff. Like, I throw it out. ISM, that's far more convincing to me. That I buy that argument, right? But the Atlanta Fed GDP now, there is a clear and plain reason why you got that move.
Yep.
It's you can go look at the data, you can go look at the front running from the exports and imports. Uh, I don't really put a lot of stock in that. Now, the bond market, right? To me, the bond market, and again, I want to be specific on what I'm talking about. I'm talking about the 10-year. The
Okay.
10-year, to me, to really make me a believer that this is quote unquote the big one, that we're going down much harder, I have to see it break 4 convincingly.
Nice.
Because right now, and I'll just pull up this chart again here. What I'm looking at, so for just hold me to this. Anybody who wants to say this is Joe's view on this. I'm looking at us sitting at 416, okay, which is, by the way, back where we're at in December. I want to see us, if we're down here, I'm a believer. Like, I don't see I'm not gonna be bullish
Hmm.
when we're sitting in the convincingly, put it this way, convincingly below 4%, because to me that's telling you the growth picture is ugly. But a 4%, like you said, you started out saying something like, this is a forward expectation of growth. Well, I mean, a forward expectation of growth still sitting north of 4%, to some degree, right? Like, because this bakes in some inflation and so forth.
Hmm.
Um, I don't know. I mean, to me,
Yeah.
that I got to see something more than that.
Yeah.
So
I think that's very reasonable too. And that's how, so my system works. Like I use these markers as sort of cutoffs. And what happens a lot of time is when it chops, I get chopped up because I go in and it goes up and then it goes down and then I go out. And then I go in and it chops. So I want to see a definitive move. And what I'm saying is I'm biased this time around to thinking that this move is for real, that I do think we're going to get your sub 4% 10-year. I mean, look at the 2-year, it's sitting at 3.92 right now. To me, that's front running the federal funds rate, and I think the federal funds rate
well, they
follows it
should.
lower. It
The
should.
Fed, but so that's the difficulty when you look at the yield curve and the different parts of it, right? If it's front running the Fed funds cuts, okay, and the Fed has already cut, which those cuts are really not going to be felt until, I think, basically the middle part of this year, because it takes time to go through the system, and they give forward guidance on the balance sheet. I mean, we could be looking at this and saying this was all a big head fake in 6 weeks. That's what
Yep.
makes this so challenging.
Yes.
And I appreciate your systematic way of saying, look, price is king. I'm going to look at the price. And what I understand you saying is, like, if the market makes a stand here and heads higher, you're going to be back on full on, uh, not necessarily bull, but bull crab, I guess, would be where you'd go back to.
Sure.
Or is
It
that right?
depends. Yeah. It depends if all the factors are with me. So I turn bullish based on monetary supply. So M2 increasing substantially. Like we still haven't seen the Fed get behind this, right? They've still been doing, as we talked about, still doing the QT, the roll off. So I want to see the Fed get behind it, and I want to see PMIs back above 50 and expanding again. So I want to see the next new orders to show that this was just a one-off. So with the new orders came in at like 48 or whatever it did, I want to see that pop back well above 50
Can
again.
you
And
can you pull up the PMI chart? You have the
let's see,
ability to do that? Let me see if I can do it.
let's see.
And then I got to get back to real work. But
Yeah, yeah.
here it is.
Hey,
I think I
this
found
is
it.
good work here, Joe. By the way, while you're pulling that up, G-Man commented, I think Jeff has a subscription to Macro 42. Darius is saying the same
Darius
thing.
Dale, right?
Darius Dale. We both know Darius well. He's a good dude. I don't have a subscription. I actually did for a bit. I like his work a lot, and I do think he is saying the same thing. And it's just because we're both looking at the same macro data, and we tend to have the same framework for thinking about things. So
There's no shame in listening to anybody.
right.
I'll listen to Dave H. Contrarian, even though I think he's ridiculous. But he's been calling for a melt up for like 5 years, right? So
Yeah, exactly.
followed by 80% deflationary bust. But okay, this is what I want to see, and we'll end with this. Okay, so again, I am open to your point of view. I'm trying to be open minded here. This, to me, just for the listeners, okay.
Which that's last month's reading, by the way, not the most current.
Correct. No, last month's reading. What is the current reading? This is not updated.
50.3.
Okay, so just for the listeners here, let's go back to you have had, and this is what I said this, March of 21, right? You have had a declining overall. I mean, obviously there's bumps along the way like any other chart, right? It's nothing straight down, but you've had basically a declining PMI since March of 21, which, by the way, that's right when Elon's on SNL pumping Doge. That's when Bitcoin made its first initial high in 21 above 60K. A lot of markets were really ripping here. This is the height of the NFT bubble and everything else on this one. And then, obviously risk assets still held up there as PMI was declining. In fact, Bitcoin made a new high here. NASDAQ made new highs. S&P made new highs all the way into the early part of 21 as you had this first decline in the PMIs. But what I wanted to point out is here, look, since March of 23, the PMI readings have roughly stayed around the range of, say, between 46 and 50 on the high side, right? And the reason why I think that is significant is despite the PMIs hovering in this area here, Bitcoin's been on an epic run. Okay, like it's been fantastic as you have seen this this trending consolidation right here. Now, to your point, right? We went to, you don't see it on this chart. If you saw it on this chart, it looks something like this. This is what you've seen in the PMI. Okay, if it were updated, that is higher than October. It's higher than November, December, right? So to me, explain to me why this is cause for concern. Just
because here, so type in Joe do USMNO. That's new manufacturing new orders.
Okay.
Oh, and it's not updated.
This is not updated yet, but this would look like this, I think.
It's down to 48, I believe. So down below 50. So that's
what it should look like.
Yeah. Which is the main thing that I follow, right? Because it's a leading indicator is what the new orders are doing. It doesn't have to, but I think that the next 1 or 2 readings for PMI itself are probably going to be sub 50 in the contraction phase again. So I totally hear you, Joe. Like that whole move from the bottom has been kind of where I transitioned from bear to crabbish and then to bullish. But to get that final, what we've seen in the last multiple years, when you get that final huge exponential move higher in Bitcoin is when PMI is rapidly expanding, shooting up to 60 and above. And so that's why I was so excited last month. And that's why I'm subdued right now is because it's looking lower.
Look, I admire people willing to change their opinions and sense when the direction of the wind changes. So if you are correct here, this is an unbelievable call. And also, if it's premature and we get a bounce here and it goes higher and you change your mind again, I don't fault you at all on that either, because that's what you should do. You should react in a Bayesian way to new data coming in and move your probabilities of bullishness or bearishness in accordance with that. I don't like people who get wedded to these views that no matter what data is coming in, I'm going to be a bull. No matter what data is in, I'm coming in, I'm going to be a bear. You should move with the data. That's the only way to do probability. So I respect that, and I do have to run to get back to work here, but anything else we should chat about?
Well, Joe, I just want to say thanks so much for coming on, man. I would love to make this kind of regular with you, maybe at least like monthly, or
let's do it. This is great.
As interesting data comes in, let's go over charts together. That'd be a lot of fun. And sorry.
One thing, quick, before I forget, I wanted to ask you about this. I know you're an MSTR bull, right? You like MSTR?
Yes, but now I'm
Not
now
now.
I'm now I'm nervous about it. Yes.
Okay, so one major market catalyst, and I keep seeing I own a very small amount of MSTR, but one thing I wanted to get your take on real quick, if you give me the TLDR,
Yep.
is that I heard a bunch of people last night in an MSTR space talking about how, look, if Bitcoin can't get moving here by the end of the month, that's going to be the key date for inclusion or consideration in the S&P 500, and obviously this is the first print where you're going to get the data on their balance sheet with the new FASB accounting standards. So my question is, let's just assume, just for the sake of argument, Bitcoin doesn't get running by the end of March, and MSTR has balance sheet that's equivalent to current levels or maybe even slightly below. What is your take on a market reaction of non-inclusion in the S&P 500 for MSTR? Is that pretty bearish, or is that neutral? Does it matter? Is it irrelevant?
I'm more in the irrelevant camp
Okay.
this time around. I just think it follows the price of Bitcoin with leverage. And so if Bitcoin can't take off, MicroStrategy won't take off either. And I agree. Like I think if unless Bitcoin takes off, they're going to have a negative quarter of earnings for the first time in 4 quarters, I believe. So yeah, that would mean they won't be included in the S&P 500.
And that carries, right? Explain this. I haven't looked at it closely. That carries for like a year, right?
Yeah, I believe you have to have 4 straight quarters of positive earnings to be in it. So yeah, they would have to go for another 4 quarters of positive earnings to get back in.
The only reason I ask is because I keep hearing this narrative about people positioned for the inclusion on their options positioning, which to me that's like a red flag, right? Like if that doesn't come true. Oops, sorry,
No worries.
I gotta go. But thank you, Jeff.
All right.
We should do this
Good
again.
talking to you.
I'll talk to you.
All right, take it easy. And I'm leaving too, everybody. Joe, thanks for coming on. We'll do it again sometime.
Awesome. Take care.
Bye. Thanks, everybody.